when we get through this tariff talk or tariff tantrum that we're going through, reminds me of taper tantrum back in the day. That and just the earnings uncertainty, there's a lot of room for the markets to calm down. And
by the way, Jim, you raise a good point. I'll put a different spin on it. Very few companies are talking about recession on their earnings calls. Like something like less than 25 companies in the S&P 500.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Here we go, guys. We are live from the Blue Vault Conference in Dallas, Texas. What is it, the 11th? March 11th? And we almost got correction territory, guys, but not there yet.
Almost.
So, for you technical guys. But very special podcast today. And our second guest on the Bull of Wall Street, Ryan Detrick, is back with his partner, SonuVarghese. Dr. SonuVarghese, by the way.
I never go by doctor still. I'm fake up.
I'm going to call you doctor. And then our own Jim Warden, CIO, and Talley and Jim, Chief Market Strategist. Both Ryan and Sonu are with Carson. And have a very famous podcast, Facts versus Feelings, FVF, I think as they call it. They actually shot a podcast earlier today here at the Blue Vault Conference. Thanks to Stacey Cheedy. We're happy to be here. But what a great day to talk about the markets, guys. I'm here just to introduce the four of them, and I'm going to be quiet and let them ramble about what they think is going to happen with both the economy and the markets. But for all the listeners and people that are going to be watching this, thank you for joining. I'm going to turn this back over to you guys. So let's talk about it, guys. What do you make of this? Let's start out with you, Ryan. Come on.
Well, first things first, thanks for giving Sonu and I the comfortable chairs. I just talked for an hour.
We appreciate it. You guys deserve it.
It's been a long day. Alts land.
I just wanted to see those flamingo socks.
Flamingo socks. There they are. Didn't even know that's what I was wearing until I looked down. So, boy, it never fails when you go out of town, market goes crazy, and obviously the time we're recording this, there's a lot of volatility. I think intraday we did hit a 10% peak to trough correction. Who knows, by the time people listen to this, maybe we're officially there on a closing basis. A lot of fear. We get to work with financial advisors, much like yourselves, all the time at the Carson Group, and there is a lot of fear out there and a lot of worry. And I like to say it like this. I like to use analogies and stories real quickly here to set the stage. 2 years ago right now, we were told there was a regional bank crisis, or there was a regional bank crisis. We were told it was the first domino to fall to knock everything down. Fortunately, we got through it. 5 years ago right now, 100-year pandemic, 34% bear market in 5 weeks. We did get through that, and within 6 months after that, we were back to making new highs. 2023 March, terrible bear market after the tech bubble burst. A war started in Iraq. And the market bottomed and rallied. So for whatever reason, you see March madness, and I think it's important for those longer-term investors out there to remember we've seen scary times before, just recently in March, and we've gotten through them before.
I think what's happening is, I know tariffs are front and center, headlines, but it's a re-rating of growth as well. And I was just thinking back to January, I think it was January 12th, we got a labor report for December. I think it was about 250 or 300,000 jobs, something like that. It's failed. After all the revisions, now it's 323. Remember that day, everyone was talking about how good news is bad news. That's how wild it got, right? And then all this to say, people are really optimistic about growth into late January. And then we started getting the data in February, January data. First thing that got hit was auto sales. Auto sales come out in the first of the month. Boom, that was down. Then we got retail sales. That was down. We got consumption data. We got payroll data. All of that suddenly got hit with negative surprises, right? And now here we are, first week of March, second week of March. I think there's been a re-rating of growth down. People are much less optimistic. And then obviously all the tariff noise, right? Too. That's like the icing on the cake.
Yeah. Absolutely. It feels like a little bit of Dr. Jekyll and Mr. Hyde with the markets. I mean, we had Claudia Som, Dr. Som on last week.
And macro.
And last year, if you guys remember, there was a period where the Som rule triggered and everyone was worried about a recession. And then we were worried about inflation. And so we've gone back and forth and back and forth. How much more back and forth are we going to have? It is like the third year of a bull market. You mentioned in your speech a little while ago that the third year's choppier. To be expected, right?
Yeah, that's right. And by the way, I do want to say thank you. Am I the first time repeat offender of the Bull of Wall Street podcast that we're going to
Yes.
Repeat offender?
Yes, we love that you guys are here with us, and
Thank you.
We so appreciate it.
Running out of gas.
Repeat offenders. Four of us talk. No, I will say I'm a big fan. Love Jimmy and you guys, all the work you guys do, the podcast. I remember when you reached out to me, I don't know, maybe 2 months ago, 3 months ago, said, "You want to do a podcast?" Well, they're kind of hard to do. Next week, you're like, "We're doing one. You want to join?" I was like, "Wow, you guys got that done in a hurry." So that was impressive by this just right there. But honored to be back and just big fans of what you guys do for the industry and the way you help your clients.
Thank you.
Everything you do, it's fun. We try to do it too, and I know we're all in the same industry. We're all friends, so it means a lot to get to do this again. And I've got Sonu for the hard questions, but I don't know the answer.
I'll try.
I don't even know what you asked me. Oh,
The third year's choppier.
So again, when our outlook came out, we released our outlook at the beginning of the year, and we wrote about this before, saying, listen, this is the third year of a bull market. Historically, what happens in the third year of a bull market? Rarely does the bull market end. All right? Since 1950, I found 5 bull markets that made it into their third year. Every one of them made it to at least 5 years. The average is 8 years. But you know what? The third year is pretty, I don't know, bad's the right way, but choppy, frustrating. Most of the returns didn't happen in the third year. It's years 1 and 2 are good. Third year, you catch your breath. It's like this huge place, right? It takes a while to walk where you're going. You got to catch your breath, and you go again. And that's kind of, I think, where we are. Now, we came out and said 12 to 15% on the S&P, still overweight equities. We've done some things in our models lately that we're still overweight, but we see the same scary headlines and risks that are out there as everybody else. But the fact that the third year's choppy, not fresh, not surprising. One more comment. The first quarter of a post-election year, stuff we've been talking about literally, all year, is one of the weaker quarters in the presidential cycle. The first quarter after a 20% gain is usually not that great. The stage was ripe for some frustration early this year, and boy, it's been frustrating and it's playing out.
Well, how much do you think of it as profit taking? I mean, I feel like we've had such a good run. 2023, not the whole year, but toward the end. 2024. I want to hear from Sonu.
No, I was just going to say part of it is everyone is. I mean, we've seen sentiment shift. Yeah, I mean, sentiment always shifts anytime, depending on what happens with prices. But we've seen more frequent shifts of sentiment, fair to say, and that's partly because I think a lot of people are probably too concentrated on one side of the market. I think in tech stocks, everyone's been, because it's obviously been riding well. There's been momentum there as well. But valuations also, Ryan's got a nice chart where he shows that, valuations don't predict anything, especially over the short term, right?
Yeah, that's true.
But then where it matters is suddenly people think, oh wait, if there's an air pocket here, the stuff that's highly richly valued probably gets hurt.
Right.
And if you look at just the S&P 500 high beta, right? The high beta index, that's down like 16, 17% year to date.
Let me just jump in here, Jim. So as you know, I love a good growth scare, and I have been waiting for a few months.
I've never heard someone say that before.
I love it.
All too.
He's not a technical guy. He's an economist.
We do it all. But the point is, it opens great entry points for patient investors, long-term investors like this. So our whole investment team from WCG is here, and they brought their monitors because they're trading and buying, legging into this market, which I think is the right approach. And that gets to what I want to discuss with you guys. Let's address the big question in the room, the R word, recession. And I'll lay it out on the table. We'll frame it this way. I learned that if you get credit right, you get the cycle right. And with spreads acting reasonably well behaved here, I'm liking the signal from that part of the cap structure. And that tells me that the cycle continues for now. What do you guys think?
Yeah, you said what you like. I like scary movies, right? And when you watch a scary movie and they go down the hallway that's dark, does the monster ever just show up right in front of them? No. It always comes from behind. It always comes from the side. You don't see it coming. So with markets, you look at the last couple of recessions. I mean, did we really see a 100-year pandemic coming? I don't know. Maybe not. But the one before that, the GFC, what you're talking about, we saw credit show major credit spreads were blowing out in late 2007,
right. Well before.
Early 2008, before what hit the fan the second half of 2008.
Yep.
I'll never forget that. I mean, no, I didn't really pay attention to that back then, but you live, you learn, you see that.
That's right.
And that's what it was. And even if you look at the late 90s, now credit was okay in the late 90s, but what wasn't was the advanced decline line. How many stocks going up versus down, cumulative basis. We saw less and less stocks going up in the late 90s. What was going up? Technology, right? That was the big thing going up. So I like to say two things I follow more than just about anything from a big picture point of view are what are the advanced decline lines telling us? And I'll tell you, we haven't hit a new high in a while in advanced decline lines, but globally, we have a lot of stock markets that are up. At the time we're doing this, the DAX is up 20% for the year, all-time high. China, Hong Kong's 3-year highs. There is some breadth out there. But at the same time, specifically to credit, right now, here and now, there's a little bit of stress, a little bit of expansion in some of the credit spreads. But you look at high-yield junk bonds and high-yield bonds, they're down a tad, but
still
nothing
low.
that would tell me this is more than that. I know Sonu can build on this, but I'll say this much. In early August, when we had what the heck was it? The yen carry trade. There's so many things escape me. I can't remember them all. The yen carry trade, we didn't see really any stress at all. Yeah, the market went down 8% in like 5 days, but there was very little stress in the credit markets. What did the dollar do back then, though? I know you were all over that one.
The dollar is falling. Usually in a crisis, the dollar starts to rise, especially in a flight to safety environment,
That's a good point.
And if going back to your question about recession, I mean, forget the COVID recession because that was an exogenous shock that came into the economy, right? So set that aside. The last 3 expansions, if you think about it, how did it break? These are credit-driven expansions. The 80s, then you had the SNL crisis that led to, then we got the 90s was, it was people think of it as a mild recession, but the economy took a while to gain all those jobs back. So from that perspective, it wasn't a mild recession. Same thing in 2000. You had a lot of corporate sector debt build up. It was a debt-driven, a credit-driven expansion in the 90s too. That broke. And then obviously we know what happened in the 2000s. That was also a massive credit-driven expansion. That's not where we are now. This expansion is mostly driven by income growth, right? It's not credit growth. In fact, credit's going the other way, right? And I think that's part of, when I look at credit spreads for high yield. And here I'll put an asterisk on this just to, I still look at it. It's one of my go-to indicators probably for both of us. Since we are at a private alts conference, to bring that in. If you look at the high yield debt market over the last decade, it hasn't grown. It's about flat. It's about $1.2 trillion. Where is all the credit gone? Where's all the, it's private credit, right? Private credit is now about $2 trillion, right? So that's the only thing where I have a little bit of an asterisk. I'm like, is this giving me the signal it's supposed to give me when I look at high yield credit spreads, right? I don't know the answer to that one way or the other, but it's something I'm thinking about right now. It's the fact that I'm here is, triggered that.
Well, I guess a follow-up question to that, during the pandemic, how many of those companies that didn't have good financial health were able to refinance at ridiculously low rates?
Thanks to the Fed as well, right? They came in and suddenly they're buying the bond funds and the high yield bond ETFs and all of that. So,
and they had a 10-year treasury at 50 basis points.
And why they didn't issue century bonds?
Why they didn't back then?
Beyond me.
Absolutely.
Yeah, I mean, if you look at like I don't know if I can give the ETF name, like HYG ETF, right? Right now, about 54% of it is double B and above. But I think about a decade ago, it was about 40%. So the quality there has slowly shifted up. I still think there's a lot of signal there if things really fall apart. So it's definitely something to watch. Yeah. But I wish we were getting more signal from the private credit side too.
Oh, absolutely.
There's one thing I wanted to bring into the conversation. So markets obviously move first. Those are the first movers. But there's an indicator that I developed last week. Jim and I have been talking about a macro dashboard to kind of help advisors and our clients get their arms around the cycle, because that's one of the first questions that we like to kind of wrestle with. And I built, and unfortunately it's not up to us I'd love to be able, to decide the peaks and troughs in the business cycle, but that's the Business Cycle Dating Committee at the National Bureau of Economic Research. But we do have an inside track because we know the 6 indicators, and they're monthly, that they use to be the ultimate arbiter of the economy. And right now, when you look at those 6 indicators, and I'll break them down in a second, 100%, 6 out of 6 are in expansion territory. So that's why I tend to be in the buy the dip camp still until that picture changes.
Well, and we can go on about the LEI.
No.
Oh, you have your own version too. I saw that. That was.
And it gets back to the idea about maybe even credit-driven expansions. And, I think all of Wall Street, one of the favorite indicators has been the ISM manufacturing PMI.
Right.
Sure.
Right. By the way, we have that in our index too.
Mm-hmm.
Right. We haven't thrown it out. We have the services version too.
Sure.
But most of our index we created about 13 years ago. Most of the index is consumption related indicators, housing data too. And that's what told us a year ago, 2 years ago, there wouldn't be a recession. Right. Or the odds, I should say, that wouldn't. That sounds too.
Odds are lower.
Odds are low. I should say odds are low for a recession. And now we have 29 of those for 29 different countries around the world. We used to have Russia, but we don't have data from Russia now. So Russia got thrown out. It used to be 30 countries. You have 29 different LEIs. And these are all, it's not one size fits all because every economy around the world works differently. Like China's economy is mostly built off of private investment or public investment, right? Fixed capital investment. Whereas Germany, South Korea, Taiwan is built off of exports, right? So every index that we have for these countries reflects how those economies work. So that's how we try to get a picture of what's happening across the global economy.
Yeah, I mean, what's so fascinating about the last couple of years, there's soft data and hard data, right? Soft data, like a survey. How do you feel? Yeah. Hard data, what's really happening? Sonu mentioned the ISM. I couldn't tell you how many times in 22 we were told, well, the ISM manufacturing sub 45, it's 8 out of 8. There's a recession every time. The LEI is negative year over year. It's always been a recession. The yield curve. Always been a recession. Those 3 were the 3 that really stick out. And I know you guys. I remember watching you.
And M2.
Yeah, M2. Don't even start with M2, Sonu. Let's not even go there. I remember watching you on Yahoo 13, 14 months ago saying, don't believe that stuff. We're going to gain 12% this year. So congrats on that amazing call you made last year. But I mean, you were getting arrows. We were getting body shots and arrows then too. And the thing we talked about on facts versus feelings all the time was, okay, we see that. That's how people are feeling. Yeah. What are the facts?
What are they actually doing?
Year over year, we got hard data was actually positive, not by a lot, but it was up year over year. And if you looked at the soft data, and believe me, the soft data matters. I mean, those feelings matter because sometimes those feelings can lead what's going to happen. But we never saw the soft data the hard data crack for years.
That's the data you were talking about with the NBER indicators.
Yes, and I would add to that while the hard data have remained pretty resilient, now the soft data has actually recovered. So
and now it may be over the last 2 days, it's going back.
Last week it happened. I hear you. I mean, just this morning, let's talk about this. Let you guys take. I'll ask you guys a question. Small businesses, right? Small business confidence is hung in there, but the uncertainty factor of small business, the NFIB, that's one that came out this morning, survey we all look at, second highest level ever. The word uncertain was in the Fed's beige book last week, 47 times. The most ever. Uncertain is, Sesame Street word of the day. It's uncertain or uncertainty. I mean, that does play into this, why the market's so volatile, because nobody knows what to do because they don't know about trade. They don't know about this. They don't know about that. How are you looking at from a model's point of view to kind of weather the storm, knowing everyone's uncertain on what in the world's going on?
I got some questions for you guys.
That's a really good one. Well, let me take this real quick, Jimmy. So I know Tally's putting out pieces. I'm putting out pieces. We're talking about navigating all the different uncertainty, and really it comes down to policy. Like, where's the policy with trade? Where's the policy with immigration? And then you get the policy with Doge. I mean, like one after one, all these things, when you add them all up, it's kind of makes you feel a little bit of angst, like what's going to happen. I think especially for those small businesses that you're saying, like, how are things going to go? Are consumers going to buckle down and stop spending as much?
Well, Jim, let me help out. There's a great quote, and it's apt for this moment in time. Neil Donald Walsh said, "Life begins at the end of your comfort zone." And that's why I love a good growth scare. I also love extreme uncertainty for the same reasons, because it really opens up these attractive entry points. And there's a chart that I published. As technicians, you'll appreciate this. Top panel, MSCI ACWI. Bottom panel, the Global Policy Uncertainty Index. And what you observe across time is that extreme spikes in uncertainty aligns very nicely with viable major lows.
Strong future returns.
Correct. Yeah.
Yeah, I've said it like this, just real quickly, so you can jump in. Markets can take good news. Markets can take bad news. They just don't like curveballs and uncertainty. And the honest truth with all this trade stuff, that's kind of what we are, what we're seeing. But we've also looked into that. What is the uncertainty index?
Sure.
What's the first one of it? Who is
Global
it?
Policy
Global
Uncertainty.
Policy Uncertainty Index. We've looked at
one on Friday as
That's the one.
There's a bunch. So you look, and yes, when you're in that top 2 or 3 percentile, like where we are right now, based on the last 20 years or so, that is usually what you want to buy. Because when things are uncertain, what's going to come next? More uncertainty? Well, maybe. Or I'm sorry, more uncertainty or less uncertainty. It's probably less uncertainty. I mean, that's probably what's going to be the case. And I almost fell out of this chair. Did you see that? That would have been YouTube gold.
That's uncertain.
Literally, if I fell
uncertain.
chair. We were at this place last night. We were at a Mambo Taxi. We went to a place like Mambo Taxis. They were margaritas. They were not margarita, but I almost fell out of my chair here. Yeah, Sonu, so what's your take on all the uncertainty?
Look, there's always some degree of uncertainty, right?
Yeah.
But now I think it's a policy piece of it. And to your point, look, if tomorrow they decided we're going to have 50% tariffs across the board, and that's it. After that, we'll never talk about tariffs again, right? And
I'd actually like to never talk about them again, but this might not be
that would be
I think companies will adjust. They'll figure it out.
Yeah.
Maybe some prices may go up or whatever, or margins may get hit, but companies figure it out. But even if we have uncertainty, look, if this lasts, right, for a long time, let's say it lasts into the next year and a half, I think companies will figure out, okay, how do we deal with this uncertainty, right? Because at the end of the day, they want to make money. They want to take market share. Nobody's going to be like, oh, you know what, I'm stepping back and I'm going to spend less. I'm going to invest less. I'm going to hire less while my competitors may be hiring.
Absolutely.
So it's going to come back at some point, especially if you don't have a recession. And to your point, right now, I don't see the conditions for recession.
And I would add, too, if you think back to, we don't have very many lessons from history on this one, but Trump 1.0, we actually had disinflation and a whiff of deflation at the end of his first term, and margins came in. So to your point, companies were willing and able to kind of absorb some of those price increases. This time around, the good news is that margins are actually higher now. They're 12%.
Exactly. There's more room.
Correct, to absorb the blow.
But I think it feels like part of the uncertainty, you mentioned air pockets a while ago. I feel like part of that uncertainty, we're so focused on quarter to quarter. I was looking at a piece, I think Goldman Sachs put it out. Fourth quarter earnings were better than expected. And looks like the first quarter is going to be lower than expected. We may actually have a dip. People are so focused on that. They're not looking at the whole year. They're not looking at second quarter, third quarter, fourth quarter. So I feel like when we get through this tariff talk or tariff tantrum that we're going through, reminds me of taper tantrum back in the day, that and just the earnings uncertainty, there's a lot of room for the markets to calm down. And
by the way, Jim, you raise a good point. I'll put a different spin on it. Very few companies are talking about recession on their earnings calls. Like something like less than 25 companies in the S&P 500.
Here's the other thing, and I think this is a big difference in how we look at it. Like, I'm not an economist by any stretch, but I look at a lot of economic data, but we try figuring out, okay, how does this matter for markets? And what's the connection between the economy and markets? It's profits, right? Profits are the connection there. So are we always thinking about that? But to that point, I mean, we saw big news in Germany last week. China, too, is having, they put a 5% GDP growth target. They usually always hit the target, but China's GDP is an input as opposed to an output, right? They say we need to hit 5%, do what it takes. Last couple of years, they hit 5%. That was through exports. I don't think they're going to hit 5% growth with exports, which means they're going to need to pump more money into the economy. If they're pumping money into the economy, Germany's pumping money into their economy to a scale that is massive, assuming all the, constitutional stuff goes through in Parliament next week or the next 2 weeks. That's good for U.S. multinationals too. 40% of S&P 500 revenues come from outside the country, right? Other countries getting into the fiscal stimulus game is good for U.S. company profits too. So I don't think we can just completely write off like, oh yeah, even if we have a little bit of a growth slowdown, as opposed to a recession, it's not going to be a big hit on profits because look outside.
Yeah. Good point.
You mentioned a taper tantrum. Just reminded me of this. That happened. Well, I mean, it happened in 23, right?
Yeah.
S&P gained 30% that year. So, like, it was pretty scary when that happened. And we heard about it every day on TV. Then you look up and things were doing better. But from one chief market strategist to the other, Tally, I was going to ask this. Sonu and I share the same brain because we talk all day. The Europe thing. I mean, we've got probably, I think it's safe to say, about an equal weight on developed markets.
Close to neutral. We're underweight emerging.
Talk about maybe do we go a little overweight? Because is it, the four most dangerous words, Sir John Templeton, this time is different. How many times for 16 years have we been told Europe looks good, you should go in? People say it on TV, they say it in Barron's roundtables, and then Europe underperforms the United States. Literally, it's happened every year for 16 years.
Valuations are low.
Because valuations are low for a reason. There's no growth there. But you're saying, I mean, the last, 2019, Germany's economy is virtually flat. U.S. is up double digits.
7 years, they've barely grown, which is incredible. The third largest economy in the world in 7 years hasn't grown. It's 0.1% annualized growth.
But now, the question, again, that we're kicking around, and who knows, by the time people listen to this, we might have added a little exposure to Europe, a little more. What do you think from the European point, or maybe developed international?
Jim, I'm going to let you have it. I've been harping on this.
No,
we don't.
So the answer is yes. Valuations are attractive, but that's not new information. You need a catalyst. I think the good news is we have a string of really interesting catalysts here. Number one to me, and I think we talked around a little bit, is the depreciation of our own currency. That was a 14-year barrier for international in general. That might be starting to change right now. That was a notable development on my radar. Another one, and I think we talked about this earlier, we've got clarity now because the political, election results from the largest economy in Europe, Germany.
Did you say clarity and election in the same sentence?
And I'm not a political strategist.
Yeah, there's a positive outlook.
But we got over that hump, right? And on top of that, it looks like, and there's a reason why the European defense stocks are rallying, it looks like Germany could be on the cusp of a major fiscal policy regime shift, the largest that we've seen since World War II.
And they have a lot of space too.
Yes.
Do it. Public debt is just like 65% of GDP.
Sure.
Right?
That's
so they have a lot of room.
Also, stocks 600 earnings expectations have been ratcheting higher. So, take your pick, guys. There's a bunch of reasons.
Yeah. Well, and
I've heard this for 15 years. I mean, honestly,
so actually on that,
there is more of a
to that.
It's actually a big deal. I think.
Yeah.
But to that point, 2017 was I think people are getting excited about international. Turned out to be another Lucy in the football case again. But you don't think it may not be that. I mean, I don't want to put words in your mouth.
So we're looking at it. I mean, we're kind of discussing it. You guys talked about possibly adding. We're talking about the same thing.
We just need to do it before they do.
Well, you have time.
There's time.
That's the consolation, right? I mean, there's such structural underperformers. You have time and the luxury to shop the sales, I think.
People remember the aughts all the time because it was a terrible time for investors, is what we're told. Right. And we were there. 50% haircuts, tech bubble, GFC. Yet, if you look around, emerging markets did pretty good that decade. Gold did really good that decade. Small caps, they were down. They did a lot better than large caps. Europe did okay, I think, in the aughts. But the reality, again, is just because the U.S., and we're not calling for a bad decade. It'll be very clear in the United States. But if the United States doesn't do much for a year or so, as this year 3 of this bull market catches its breath, maybe there are other parts. The lifeblood of a bull market, I say this all the time, but lifeblood of a bull market is passing the baton. Rotation.
That's true.
We get a little rotation in some other parts of the world, and that's why I think from a diversified portfolio point of view, with working with financial advisors, smart guys like yourselves, with the team you have, to have some of that diversification helps you sleep at night as well.
And by the way, so I actually was the global equity strategist at Oppenheimer Funds back during Trump 1.0. And who would have thought? Same kind of rhetoric and barriers to performance back then. EM had a couple of banner years in his first term. Massive outperformance.
Exactly. No, one thing you mentioned, you brought up currency. We've been talking a lot about currency too. in our, we did this very MBA-ish thing. No offense to MBAs, right? We did like strengths, weaknesses, opportunities, threats.
Yeah.
Right? Like neither of us have an MBA. I don't think anyone on our team does. But anyway, so
I have an MBA.
You do?
I do.
I didn't know that.
I swear. I don't brag about it like you do, doctor. But
Okay. That's right, Ph.D. I'm doing the SWOT analysis on Ryan here, but no, one of the threats we had was obviously tariffs was like front and center, but then the dollar, a higher dollar, was a risk. We didn't think it would come to pass, but it was a risk because going back to international earnings, if the dollar is more expensive, that hurts international revenues for U.S. firms. But if you go the other way, that's a tailwind.
Yeah.
That's a tailwind for U.S. multinational revenues. It's also a tailwind for U.S. dollar-based investors in international equities, right? So
that's part of your total return, the currency component.
Totally.
Unhedged, folks.
If everybody's thinking alike, somebody's thinking. General Patton, I said on our team a lot at the start of this year. I think one of the bigger contrarian trades that's going to go opposite and rip everybody's face off is a lower dollar because everybody promised us a higher dollar. I look back at 2017, Trump 1.0. What happened? Dollar was lower, even though it wasn't supposed to be lower. And Trump's been out there saying he wants the dollar to go lower. I'm not saying he can push the currency market around. No one can push the currency markets around. I want to be very clear. But still, that's what we're seeing, right? The dollar just had its worst week in years last week. Yeah. That's a big reason why EFA was up 3% last week and US was down 3% because there's this repricing risk, if you will. But at the same time, I think the dollar made a major peak. I think that's not only too crazy to say now with the drop we've had, but I think it continues to work its way a little bit lower, which could help again an international portfolio.
So we're kind of along the same lines as you guys. We've been saying that we think rates will go down. A lot of people have been saying, "Oh, rates are just going to go higher. We're not going to get any cuts." I feel
like folks are like, the Fed shouldn't have cut.
Yeah, it's wild. Well, and it's weird. You look back just a few months ago, and I think the Fed funds futures were pricing in like 10 cuts. We're all worried about, because the Somm rule triggered and we're going to have this recession. And then it got to 1 cut. And we've been saying 2 to 4 is likely.
Yeah, we are in the same camp as well. And even last year, a year ago this time, the market is pricing in 7 rate cuts in 2024. Yeah. And people always you'll get, no, I think we said 3 to 4. And it kind of worked out because
we were saying that too.
We changed our forecast here live on the pod. It was 3 to 5.
But the Fed cut 3 times, but they cut 100 basis points, right? So we're like, oh, that's a nice way of having a cake and eating it too, right? It's 3 to 4 cuts. But yeah, no, I think the market can go again as markets price growth, or price, recession, all of that. I think one thing that confused a lot of people in September, after September through December, they're like, wait a minute, the Fed cut, but rates are going up. But they forgot what happened from July through September when everyone was talking about a recession. They're like, oh, maybe the Fed should cut 7 times, right? So the 10-year yield went down a lot. And it was actually what you saw in the fourth quarter was mostly catch up back to, things are not falling off a cliff.
They're not falling off a cliff. And inflation is not going straight down. It's taking a little longer for inflation to go down, which we've been saying for a while. Sometimes we feel like a broken record on some of these things. It's going to take time for inflation to come down, right?
All right. How about some financial advisor questions?
Yes.
You guys need to do this often. I like this. But
go ahead, Jimmy.
Well, so we're down almost 10% off the top. What do you guys think? I know. So here's a preface to that. All 4 of you believe that we should be due for a correction. Especially Ryan, I heard you talking about second half of February, even trying to time this thing into the first half of March. How far do you think this thing goes on this cycle? And then what do you think might happen at the end of the year as far as the markets go? Dr. Sonu, let's go.
You first. Going to throw it to Ryan because I know. No, look, I'll give the cliched answer that you need to expect volatility. But look, part of it is over the last 15 months.
Short-term cautious, long-term bullish.
Yeah. Oh my God, there we go. No. Over the last what was abnormal was that we haven't seen volatility, right? Over the last 15 months, we haven't seen a lot of it, except that spike last August during the yen carries rates, which I think 99% of people are like, what is that about? What was actually going on?
I still don't know.
Set that aside, right? But no, I think so. We are kind of, not that the market, people sort of anthropomorphize the market, thinking like the market's like one person, but it really isn't. Like, we're due for a correction. And like, why? Because we haven't had one for a long time. But kind of. We haven't had one for a long time. So, and that's when things get stretched. Then I go back to, okay, everyone's on one side of the market. Everyone's concentrated maybe into technology stocks, things like that. Valuations are slightly rich. So if we do get that, going back to the air pocket idea, suddenly things go down fast. And it's the stuff that went up a lot that go down. And then you think about, there are a lot of funds doing things like volatility-based target volatility funds, right? So then when they degrows, what do they sell? They sell the stuff that's gone up a lot.
Yeah.
Right. So I think that it goes back to you.
And they go risk off. It's, because we have a tactical model. I think you guys do too, that these things will systematically remove risk as needed. But as things normalize, what do? They add risk again. And so as volatility, uncertainty comes down, we're bullish. That, we don't stay where we're at right now.
So there's reflexivity, right? I think what Soros talked about it, because volatility has gone up, that triggers certain actions in a lot of these funds. But on the other side of it too.
Yeah.
Right. You see that. And I think that's one reason why high beta names have really gotten hit. What's interesting is momentum's not gotten hit. So there's a difference, a divergence between momentum and high beta. Momentum names have actually been mostly financials. They've hung in there until this Monday, right? So
and you get the rotation and momentum too, because they're not always going to be the same names. It's not always going to be Nvidia and Tesla. You're going to have Costco in there,
right?
And maybe Eli Lilly or Walmart or some of these other financials, like you said.
So it was the beta trade that got hammered. Momentum saying.
And I think that reflects the growth scare, as opposed to what's happening now is not a recession scare, because a recession scare, I think everything just gets hit. Right, we haven't quite seen that with financials yet.
I gotta say, I'm impressed because Sonu, you didn't even answer what he asked you. He asked you.
I love how to do that.
He comes to 126 podcasts with me. You see me on TV. People always say, "You on TV? You know what's going to ask you?" I said, "No, but I know I'm going to tell them." That's the first thing Ryan Detrick taught me. Yeah. I'll answer your question, Jimmy. But I will say, Talley, it's funny. We just made the joke about short-term cautious, long-term bullish. That'd actually be a really good name for an outlook. Literally, no, for an outlook. It's like a play on. It's kind of goofy.
Well,
but it's true.
It is true. My language is a little bit different. It was tactical defense, strategic offense.
That sounds no, anyway. Jimmy,
spot on, Jim.
We were on record this year thinking we'd have a double-digit correction at some point during the year. And what I already mentioned, early in the year tends to be weak. First half of the year could be a little dicey with some of the tariff stuff. I don't think it's shocking it's happening right now. Right now, maybe it's shocking that every day is a 1% move. Every day we've seen a 2% move. But like I said, most years you do see some bad days. I mean, I'll be on record of saying I don't think this is going to get much worse than 15%. Right? I think 12 to 14% makes sense. It's probably where it would stop if we get there. I don't think it's going to be 15%. We don't see a bear market because a lot of the data Sonu does and says the economy is still hanging in there. We're just repricing risk in a way here. So I think that's where it is. The geeky technical stuff, stocks over, how many stocks are oversold, looking for positive divergences, RSIs. We're seeing some of those things. I mean, last week, again, I know the time we're recording this, but depending on when people listen to it, but we saw less new lows last week than we did the week before. The S&P was down 3%. How'd that happen? Well, because less stocks are going down. That tends to be a sign that there's some positive under the surface. We call them positive divergences. I have a CMT behind my name, Chartered Market Technician. That's what that stuff means. And it can be blown up with news. News trumps charts. We are all seeing that this year. We are experiencing it this year. But there are some reasons, I think, here to think this is going to be fairly contained. And we're going to look up and say, oh, that's right. Just like the yen carry trade on wine. What the heck was that? Hopefully we look up, and I'm not saying we're going to forget the tariff stuff that's going on right now, but in 6 months from now, a year from now, hopefully we look up and we're past it. Like you said, Sonu companies are going to find ways around it.
Figure it out.
Consumers are still going to go places. This hotel's still crowded. The airport, we're in Dallas, right? I mean, the airport in Dallas looks pretty darn crowded.
It's still crowded.
Yes, there's still some reasons to think this is a solid economy that might be slowing down a little bit, but you know what? Growth scare, like you said, you love growth scares, a little slowdown. It happens, and it's happened before. But as a CIO of a very large RIA, what do you think about advisors? How do you help advisors when times get scary? Are there special things you guys do? Calls, notes? What do you do to help advisors? This is what we love to do. So I'd love to.
Absolutely. So for us, it's all about communication and education, and we can't over communicate, right? over educate, and just calming. I would say, for a lot of advisors who are talking to nervous clients, we put out a piece recently. It's when in doubt, zoom out. This is looking at the charts, and so I don't know. We probably can't see the chart here, but Sarah, if you want to pull up chart 1, this is just looking at what we're going through right now. It's recent, so we can't see this here, but this is all the support levels. So as one CMT to another CMT, we look at support, and there's a lot of areas where we can see there's support.
Call it the Charlie Brown shirt, right? It looks like a Charlie Brown shirt.
Charlie Brown, lots of support. But then again,
step away from losing me.
Okay, sorry, we've been a little too technical. But then the point was, when in doubt, zoom out. You zoom out. We have a chart similar to your chart that you showed a while ago. Ours goes back to 1928, and it's a regression chart, and it's got 1 standard deviation above and below the mean, and 2 standard deviations. But in layman's terms, it's risk. How much risk? Now I'm talking your language, and looking at where we're at, we're like right along the mean. It's just a little tiny blip. So when you zoom out, all of this headline 24/7 media, that's what's gonna happen, it's not that bad.
Love it. I can literally visualize. When you said standard deviations, I was like, now I can visualize.
I zone out. I heard the word alpha, beta. I zone out when I hear that stuff.
How about this one? So, and we love this refrain, and this is another answer to your question, Jimmy. I'll do it my own way, my own language and style.
Well, so far I'm batting 1 out of 3 is the answer to my question.
So I think I'll give you a non-answer. It's time in the market, not timing the market. And I always love to bring it back to that. But I would say, in fairness, when it comes to our outlook, because Ryan brought it up, and part of the positioning component of that was tactical defense, that has been spot on, Jim. And that's true at the asset allocation level, because we've liked bonds here.
Mm-hmm. Duration. We've added durations prior to this because we thought we need a little bit of insurance because we may have a pullback.
So on the bond side, that's been working, and on the equity side, your consumer staples tactically has been bouncing. Now, and that's great. Now, I would add to that, and I've said, and I'll just reiterate the same stance, that while I think defensiveness has been working in the very short term, I don't want us to overstay our welcome there. And the only way that I could get on to the persistent defensive outperformance, that bandwagon, is if we are on the cusp of a recession. And I'm just not quite seeing it yet. And so that gets me to playing offense. And that's international trade right now, I think.
And one thing we've done to that exact point is, since a few days before election day, I think, is when we first started to layer it in, is play a momentum, low volatility barbell. So there's a defensive aspect to it, but also at the same time, he talks about what's in momentum. It's mostly financial. And that's a bet on the economy. More than perhaps any other sector. Set aside energy. So it dances to its own tune.
All right, guys. I think I was 1 out of 4. Thank you, Ryan, for answering that question. But I was just reading a book, and the book said you have to make sure you're asking the right question. So actually, that's a very unfair question, because how could anybody know exactly what's going to happen, right? But at least Ryan took a shot at it. So, great conversation. What do you guys want to leave the listeners and people that are watching this with?
I've got one. I was thinking of this. So we've got our technicians kind of on this side and our economists on that side. In a way. It's a little joke I'll leave you on. And this is Brian's final words of wisdom, but I love this one. There's a technician and an economist at a bar hanging out at the bar, and there's a knife on the table. Accidentally, the technician knocks the knife off the table. It falls straight down, barely misses the foot of the economist. The economist goes, "What'd you just do? Why'd you not try to catch that?" Technician
don't want to catch a falling knife.
Technician goes, "You know me. Technicians never try to catch a falling knife." And then we looked at the economist. We go, "Why'd you not move your foot?" The economist goes, "Well, I didn't think it was going to fall that far."
Love it.
Those are my words of wisdom. No, but listen, I'm honored to have been back, guys. Big fans of what you do. Sonu and I have had fun at this conference and learning from you. team, and Jimmy, all of you. So this is an honor. I look forward to doing the third one. I don't know, give me a little break. Let's get this tariff stuff out of the way before I come back. But this was a lot of fun. So thank you.
Thanks for being with us.
Thank you very much.
Thank you so much.
Appreciate it.
Fun.
Sonu, you got any words of wisdom? You can say something back.
No, you already said, enough.
I'll leave it at that. That's a joke. That's a good joke.
Honest joke.
I can't top that. I'll say, look, we come back to the point about uncertainty. When uncertainty is high, what we are doing in our portfolios is, we are less certain about, last 2 years, we've been pedal to the metal with respect to how much equity exposure, overweight equities you want. You pull back. We're not taking that much active risk anymore. We believe in diversification, including bonds and gold and managed futures, international too. So all of it. So we've sort of fallen back to, an idea that's not worked for 15 years, which is diversification.
And I would add, so another question is, if I don't like defensives here persistently, what do I like? What are we buying? I'll repeat what I've said in the past. I like buying cyclicals here at better prices. And that's what we have in this 10% or so pullback.
Come and dance on our floor.